In today's video, I want to talk about the major upcoming IPOs. We've all heard about them: SpaceX, Anthropic, OpenAI. I want to talk about how they're changing the game when it comes to investing markets. And when I say changing the game, I mean that in the most literal sense. Index providers are rewriting their eligibility rules because the existing playbook just wasn't built for companies that are this large, moving this fast, and they're all unprofitable. So we're going to talk about the opportunity or the dilemma, really depending on how you look at it, that are facing markets right now, and how indexes like the S&P Dow Jones, the FTSE Russell, and the Nasdaq are all reacting and deciding who gets into the club, how fast, and on what terms. Whether you're an active trader, a passive index fund holder, or really just someone who owns a 401k account, this wave of change is going to hit your portfolio whether you're paying attention or not. So let's start with what's actually happening this week. SpaceX will be available for trading on Friday, June 12th, after being priced on June 11th. It filed its confidential IPO back on April 1st with a raise target of up to $75 billion. The valuation range that I've been seeing is between $1.25 to $2 trillion. And to put this all into perspective, Saudi Aramco's IPO back in 2019, which was the largest in history, raised $29 billion. So right now, SpaceX is almost trying to triple that. Goldman Sachs is leading the way. It's leading a group of 21 different banks to bring this IPO to market. And Elon Musk is reportedly allocating around 1/3 of the 4.2% of IPO shares to retail investors. This is significantly higher than most IPOs, and I think it's being done to capitalize on Musk's cult-like retail and meme investor following in order to drive up demand. But listen, guys, I encourage you to not just get lost in the size of this IPO. SpaceX reported 2025 revenue of $18.6 billion, and despite all of that revenue, the company posted an operating loss of $4.9 billion. This heavy spending is going toward xAI, which merged with SpaceX, as well as rockets and other infrastructure. Within SpaceX, Starlink is basically the crown jewel. It operates over 7,500 satellites in low Earth orbit, and it's the largest active satellite network ever deployed. As such, the connectivity segment currently drives the majority of SpaceX's revenue, but the AI and data licensing segments are growing fast. For example, a 3-year compute deal with Anthropic worth $1.25 billion per month could meaningfully accelerate revenue in the second half of this year. Anthropic was the next company to file for its IPO, and from what I hear, the timeline is likely to take place after Memorial Day. The filing came within days of closing a new $65 billion Series H round, giving them a $965 billion post-money valuation, which actually beats out OpenAI in terms of pricing metrics. A lot of Anthropic's success comes from the enterprise adoption it's seen and the hope that they will achieve positive cash flow by 2027 to 2028, which as of now, those dates is a more near-term profitability path compared to OpenAI's. As you could probably guess, big banks like Goldman Sachs, JP Morgan, and Morgan Stanley, they want to take part of this, and they're said to be acting as the underwriters for this IPO. As of the date of recording this video, OpenAI actually just filed its confidential IPO. OpenAI is projected to lose $14 billion in 2026 and does not expect to reach profitability until 2029 or 2030. The CFO, Sarah Friar, has flagged late 2026 as the most likely IPO listing window. And while ChatGPT was really the first of its kind on the block and dominated market share, since then, ChatGPT has been losing share in AI search while Claude and Gemini's share continues to grow. Now that we've gone over the individual companies, let's talk about how their IPOs affect you and your investing. These major IPOs have created an identity crisis inside the index industry unlike anything I've ever seen since being involved in markets. 3 major providers, the S&P Dow Jones indices, FTSE Russell, and the Nasdaq, are each responding differently. And the differences matter enormously, especially for passive investors. So let's start with the S&P 500, because that is where the most important debate is happening. The S&P Dow Jones Indices, which is the institution that governs the S&P 500, has announced a formal review of its eligibility requirements in order to examine whether these mega cap companies should face looser entry criteria and be eligible for fast track inclusion in the index. Under the proposed changes, newly public companies could qualify after just 6 months of listing rather than the current 12-month minimum. And more importantly, and really more controversially, the existing requirement for profitability could be waived entirely for companies that qualify as megacaps. Now, these changes ended up not being put into place, which forces SpaceX to hop over more hurdles to be included in the S&P 500. While the S&P 500 held firm on its rules, there were other indices that S&P Dow Jones Indices manages that did change its rules to make it easier for SpaceX to be included. The FTSE Russell moved in a completely different direction. They've confirmed that they are implementing a new fast entry rule for the Russell US indexes that are to take place immediately. Now, companies that would qualify for the Russell Top 500, which are the largest 500 companies in the Russell universe, are now eligible for entry just 5 days after their initial listing. 5 days. That's a huge change from the original model. And FTSE Russell executives, they were pretty straight to the point about what drove this change. They have said that the upcoming IPOs of SpaceX, OpenAI, and Anthropic has created pressure from clients for mechanisms of inclusion that were just not possible under the current method. In order to join the Russell Top 500, the breakpoint is currently around $17.5 billion. So any company entering the market above that value is now eligible for the 5-day fast entry window. And all of the upcoming IPO valuations are significantly higher than this threshold, meaning they will all be eligible for this 5-day fast entry threshold. The Nasdaq has taken its own approach. The exchange has tweaked the methodology on the Nasdaq 100 index to allow IPO inclusion just 15 days after the initial listing. This is down from a previous window of 12 months. However, Nasdaq did keep the weighting cap structure the same, which limits any single company to a maximum weight in order to prevent too much concentration. So here's the reality that very few people are talking about. When a multi-trillion-dollar company like SpaceX or Anthropic goes public, the underwriters don't just dump the entire business onto the open market on day one. According to the filing details, SpaceX is looking to float around 4.2% of its total shares to the public, while the remaining 95.8% of the equity is locked up and completely insulated from open market trading. This creates a massive mismatch for fast-tracking indexes. If an index provider like FTSE Russell or the Nasdaq forces inclusion in 5 to 15 days, based on the company's total multi-trillion-dollar scale, the automated index funds are forced to calculate their purchases against that total size. But when they go out into the market to execute those large, multi-billion-dollar buy orders, they face a tiny public float. And there are very few shares available to buy, which triggers an artificial short squeeze. You have the largest asset managers on earth who manage trillions of dollars in retirement money, legally mandated by their index tracking rules, to basically outbid retail investor hype and buy a specific number of public shares. This drives the valuation to incredibly speculative levels that really has nothing to do with company fundamentals like cash flows or performance. In this system, the index rules themselves basically become the driver of the stock's volatility and turn passive retirement vehicles into active participants in a float squeeze. Another hidden reality of this IPO wave is the penalty that it places on the rest of the stock market. There's just not enough available capital to accommodate these new arrivals without liquidation of other positions. And think about this, if you have a passive index fund tracking the Nasdaq 100 or a broad market growth index, those funds have to maintain strict percentage allocations to every stock within that basket. So when 3 giant companies enter the index, really almost at the same time, they demand a massive percentage of the total index weight. As such, the fund managers can't just print money to buy them. They're forced to execute multi-billion-dollar sales across their entire portfolio to fund new purchases. And to make space for the new megacaps, index funds will have to trim their positions in the other hundreds of companies below the top tier. Stable and profitable industrial, consumer, and other tech companies are going to be facing a long-lasting selling wall just because they aren't worth trillions of dollars. And this creates an even larger fragmentation inside the indices, which goes back to the idea that I brought up in my past video, and the S&P 500 is lying to you. The headline index value might hold steady because the new tech giants are absorbing passive buys every 2 weeks. But underneath the surface, the average stock in your portfolio is getting starved of capital. The idea that bids once lifted all boats inside an index is really being narrowed down and turning broad market indexing into a highly concentrated bet on really uncertain and unprofitable companies, while middle corporate America, they absorb the capital shock. So here's the bottom line. We are entering an IPO cycle that is unlike any other cycle ever seen in market history. 3 companies, one being a rocket and satellite company, another the creator of ChatGPT, and the last being the maker of Claude, they are all heading toward public markets at valuations that would put each of them among the largest companies on Earth. The index infrastructure that governs passive investing was just not built for this, and the providers know it, which is why they're changing the rules in real time. And if you hold a broad market index fund, an S&P 500 ETF, or a Nasdaq 100 product, and really most Americans do, whether it be in a general brokerage account or in a retirement account, your portfolio will be affected by these decisions, really whether you like it or not. So the smart move is to understand what is coming and to act accordingly. That is all that I have for you guys in today's video. Thank you all for watching. It'll be interesting to see how these IPOs play out this week and in the coming months. If you have any questions, please leave them in the comments below and I'll be sure to respond to them. I hope you enjoyed today's video. Please subscribe to the channel and I will see you in the next one. Have a good rest of your day.